Welcome students to Accounting 201. Chapter 1 is about accounting and the business environment. We have several learning objectives that we'd like to cover in this chapter. We're going to cover the first 5 in Lecture 1 and the second 5 in Lecture 2. These learning objectives in the first half are to define accounting vocabulary, define the users of financial information, describe the accounting profession and the organizations that govern it, identify the different types of business organizations, and delineate the distinguishing characteristics and organization of a corporation. I would like to set the scene a little bit for you and ask you a question. If you opened up this video recording and I were speaking French, I wonder how many of you would actually understand what I was saying. Just like Americans speak English, the business world speaks accounting. So when you enter the business world, all of these accounting terms are going to become very common to you, at least we hope. Accounting is simply the language of business. It is an information system that measures business activity. It processes the data into reports. It communicates the results to decision makers, and it presents the information in monetary terms. After we have presented this information, we need to know who the users of this accounting information will be. So we do have several people that are going to be using this information. People use accounting information to manage their cash, to evaluate a new job, and to decide whether they can afford a new item. Business owners use accounting information to set goals, to measure progress toward these goals, and to make adjustments when needed. For example, a video game store must decide how many gaming consoles to buy. Accounting information helps provide this information. Outside investors often provide the money to get into a business or to get a business going. To decide whether to invest, a person predicts the amount of income to be earned on the investment. The investor then analyzes the financial statements and keeps current with the company. Any person or business who loans money is a creditor. Before lending money to an individual or a business, a bank evaluates the borrower's ability to make the loan payments. A bank will analyze financial statements to determine this. Lastly, local, state, and federal governments levy taxes. Income tax is figured using accounting information. Sales tax depends upon a company's sales, and the Securities and Exchange Commission will review these statements for fraud. There are different branches of accounting, each providing different kinds of information. The first part of the textbook focuses on financial accounting. You'll learn about managerial accounting in a later course. Financial accounting provides information or data for external decision makers, such as outside investors and lenders. Managerial accounting focuses on information or data for internal decision makers, such as the company's managers. This is a short exercise and it reviews the users of financial information. A company, Greg's Tunes Inc., needs a bank loan in order to purchase music equipment. In evaluating the loan request, the banker asks about the assets and liabilities of the business. In particular, the banker wants to know the amount of business's stockholders' equity. The banker is an external user who needs to review the balance sheet. The third learning objective is to describe the profession of accounting and the organizations that govern it. Accounting is considered a profession just like law and medicine. To become a certified public accountant, a person must pass a qualifying exam. In addition, each state has its own rules about education and experience requirements. Most accountants are paid quite well. For example, the average starting salary in 2007 for a college graduate with a bachelor's degree in accounting was almost $44,000. A graduate with a master's degree earns about 10% more to start, and a CPA earns another 10%. Accountants either work in public accounting or private accounting. People who work in CPA firms are public accountants. Many accounting firms are organized as partnerships, and the partners are the owners. It usually takes 10 to 15 years to rise to the rank of partner. The partner of a large accounting firm earns from $150,000 to $500,000 per year. Accountants who work for a business or nonprofit are in private accounting. In private accounting, the top position is called the Chief Financial Officer, or the CFO. And a CFO earns about as much as a partner in an accounting firm. Accountants get to the top of the organization as often as anyone else. Accountants must deal with everything in the company in order to record all of its activities. Accountants often have the broadest view of what's going on in the company. In the United States, the Financial Accounting Standards Board, or FASB, a privately funded organization, formulates accounting standards. FASB works with the governmental regulatory agencies like the Securities and Exchange Commission, or the SEC. The SEC is the U.S. governmental agency that oversees U.S. financial markets. It also oversees those organizations that set standards like FASB. The FASB also works with congressionally created groups like the Public Companies Accounting Oversight Board, PCAOB, and the private groups like the American Institute of Certified Public Accountants, AICPA. And the Institute of Management Accountants, IMA. The guidelines for public information are called the Generally Accepted Accounting Principles, or GAAP. GAAP is the main U.S. accounting rulebook. Some of these guidelines are described later in this chapter. Currently, the SEC has indicated that the U.S. GAAP will move to converge with International Financial Reporting Standards, IFRS, published by the International Accounting Standards Board as early as 2010 for some companies. Ethical considerations affect accounting. Investors and creditors need relevant and reliable information about a company. Companies want to be profitable and financially strong to attract investors, so there is a conflict of interest here. To provide reliable information, the SEC requires companies to have their financial statements audited by independent companies. An audit is an examination. The independent accountants then issue an opinion that states whether or not the financial statements give a fair picture of the company's financial situation. The vast majority of accountants do their jobs professionally and ethically, but we never hear about them. Unfortunately, you only hear about the ones that cheat or make headlines. In response to the Enron and WorldCom reporting scandals, the U.S. government took swift action. It passed on the Sarbanes-Oxley Act, which made it a criminal offense to falsify financial statements. It also created a new watchdog agency, the PCAOB, to monitor the public's faith in financial reporting as it currently exists. The AICPA, Code of Professional Conduct for Accountants, provides guidance to CPAs in their work. Ethical standards are designed to provide relevant and reliable information for decision making. A certified public accountant assumes an obligation of self-discipline above and beyond the requirements of law and regulations, and an unswerving commitment to honorable behavior. Management accountants have an obligation to the organization they serve, their profession, the public, and themselves to maintain the highest standards of ethical conduct. The fourth learning objective is to identify the different types of business organizations. Before accounting could even start, we have to have a business. The proprietorship is a single owner called the proprietor, who often manages the business. Proprietorships tend to be small retail stores or professional businesses such as attorneys and accountants. From an accounting perspective, every sole proprietorship is distinct from its owner. The accounting records of the proprietorship do not include the proprietor's personal records. However, from a legal perspective, the business is the proprietor. The proprietorship has one owner called a proprietor. A partnership joins two or more individuals as co-owners. Each owner is a partner and can commit the partnership into a binding contract. This is called mutual agency. Mutual agency means that one partner can take all partners mutually liable. Many retail stores and professional organizations of physicians, attorneys, and accountants are partnerships. Most partnerships are small or medium size, but some are gigantic with thousands of partners. For accounting purposes, the partnership is a separate organization distinct from the partners. A partnership has two or more owners called partners. A corporation is a business owned by a stockholder or a shareholder. These are the people who own shares of stock in the business. Stock is a certificate representing ownership interest in a corporation. A business becomes a corporation when the state provides its articles of incorporation and the first stock share is issued. The articles of incorporation are the rules approved by the state that govern the management of the corporation. Unlike a proprietorship and a partnership, a corporation is a legal entity distinct from its owners. A corporation has one or more owners called shareholders. A limited liability partnership, each member or partner is liable for only his or her own actions and those under his or her control. Similarly, a business can be organized as a limited liability company. This is called an LLC, and is the business and not the members of the LLC is liable for the company's debts. This arrangement prevents an unethical partner from creating a large liability for the other partners, much like the protection the corporation has. Today, most proprietorships and partnerships are organized as LLCs and LLPs. An LLC has one or more owner called members. A not-for-profit is an organization that has been approved by the Internal Revenue Service to operate for a religious, charitable, or educational purpose. A board, usually composed of volunteers, makes the decisions for the not-for-profit organization. Board members have fiduciary responsibility, which is an ethical and legal obligation to perform their duties in a trustworthy manner. A not-for-profit has no owners. This slide compares the various types of business organizations in terms of ownership, life of the organization, and liability for business debts. The fifth learning objective is to describe the characteristics and organization of a corporation. A corporation is a business entity formed under state law. The state grants a charter, which is the document that gives the state permission to form a corporation. This is called authorization because the state authorizes or approves the establishment of the corporate entity. A corporation is a distinct entity from a legal perspective. It's an entity that exists apart from its owners, the stockholder and the shareholders. The corporation has many of the rights that a person has. For example, a corporation may buy, own, and sell property, enter into contracts, sue, and be sued. Assets and liabilities in the business belong to the corporation and not to the individual stockholders. Corporations have continuous lives regardless of changes in the ownership of their stock. Stockholders may transfer stock as they wish by selling or trading the stock to another person, or giving the stock away, bequeathing it in a will, or disposing of the stock in any other way. The transfer of the stock has no effect on the continuity of the corporation. Proprietorships and partnerships, on the other hand, terminate when their ownership changes for any reason. Mutual agency of the owners is not present in a corporation as it is in a partnership. This means that the stockholder of a corporation cannot commit the corporation to a contract unless that stockholder is acting as an officer in the business. A stockholder has limited liability for the corporation's debts. Unlike proprietors and partners, a stockholder has no personal obligation for corporation liabilities. The most that a stockholder can lose is the amount he or she originally paid for the stock. On the other hand, proprietors and partnerships are personally liable for the debts of their businesses. Stockholders own the business, but the board of directors, elected by the stockholders, appoints corporate officers to manage the business. Thus, stockholders don't have to manage the business or disrupt their personal affairs. Government regulation is a disadvantage for corporations, and it can be expensive for a business. Corporations are separate taxable entities. They pay a variety of taxes not borne by proprietorships or partnerships. Depending on the state in which the organization incorporated and the state or states in which the corporation operates, the taxes could include some or all of the following. A state franchise tax is paid to keep the corporation charter in force and enables the corporation to continue in business. Corporate earnings are subject to double taxation. First, the corporations pay their own income tax on corporate income. Then, the stockholders pay personal income tax on the cash dividends that they receive from the corporation. This is different from sole proprietorships and partnerships, which pay no business income tax. Instead, the tax falls solely on the individual partners. Creation of a corporation begins when it is organized. Called the incorporators, they obtain a charter from the state. The charter includes the authorization for the corporation to issue a certain number of shares of stock, which represent the ownership in the corporation. The incorporators pay fees, sign the charter, and file the required documents with the state. Once the first share of stock is issued, the corporation comes into existence. The incorporators agree to a set of bylaws which act as the constitution for governing the corporation. The ultimate control of the corporation rests with the stockholders, who normally receive one vote for each share of stock that they own. The stockholders elect the member of boards of directors, which sets policy for the corporation and appoints the officers. The board elects a chairperson, who usually is the most powerful person in the corporation. The board also designates the president, who, as chief operating officer, manages the day-to-day operations. Most corporations also have vice presidents in charge of sales, operations, accounting and finance, and other key areas. This short exercise will end this lecture, and it reviews the determination of Chloe Michaels to open her business as a corporation. Take advantage of the limited liability and unlimited life features.